IRA, self-directed IRA. We got Jack Kiley here. A couple administrative notes. One, we normally go around the room and we do a quick round robin of who everybody is and what we do and what we're looking for. I think I'm going to hold that till the end because tonight we're merging two groups. One that was intended to be virtually, of which we're streaming it to our to the PRIA Facebook page. If you haven't done that yet, you're out of town one weekend and you missed a meeting, so feel free to pop on and do that with us. So we're gonna forego the announcements or our introductions, and what we'll do is we'll hold them to the end when we get off the stream. That way we don't just bore the tar out of the guys. Anybody that's listening, because I don't have a camera that we can go, do the faces, so it just kind of be us mumbling in the background. The other one is when we have some questions, because I think Jack's like, hey, ask questions.
Yep.
While we're going along, I've got another microphone that I'll be passing that I'll come to you and you can ask the question. It doesn't amplify the sound in the room, but it will allow the people that are listening on our live stream to kind of understand and hear what you're asking. What's the other thing that I wanted to say on our notes for this evening? Don't forget we've got a Facebook page. We've got the meetup page, and the next question is, who's here for the first time? 1, 3, 4. How'd you guys hear about us? Friend, Steve, friend. Good cheerleaders over here. How'd you hear it? From friend. All right, good. All right. So that's, in the real estate world, what is it every realtor tells you? The best compliment is a referral. So thank you very much for your friends referring you. Hopefully you'll get something out of this evening. You'll come back 1, 2, and then you'll refer yourself or refer us to someone else. I was telling Jack earlier that I had a deal that I did a while back. It started out at one level and it's changed and went to another level, but I am kicking myself in the pants for not using my IRA to do my last deal. It's the end of the year, so I'm collecting all my news, all my letters and everything. And one of the collections is, okay, here are my financial investments. They always give you your end of the year reports and your statements. And I don't know what your IRA is invested in, but mine's down 30%. So not a good year to be thinking about, retiring, of which my wife keeps pushing me to retire. All right. So with that said, I'm going to work real hard this year to get money into the project with a self-directed IRA. So I was involved with Jack and his group last year. I missed several meetings, but I wanted the ones that I'd made were phenomenal, and I wanted to get him back over here for us selfishly because I wanted to make up those meetings that I missed last time. Tonight is an introduction to you investing with your self-directed IRA or investing with your IRA. He'll explain the self-directed part to you. And he has several different meetings that go on throughout the year that we will let you know about. And I don't know if we're going to do them on a PRIA night. We may do them on another night, just to make sure that we can get our information out there. Okay, so without further ado, I'm going to pass you off to Jack Kiley with Atlantic IRA. He's going to give us everything we didn't know about self-directed IRAs. Thank you very much. Thanks for coming, by the way.
Oh, you're welcome.
And,
thanks for having me.
And going through the machinations to make this happen.
That's okay. I'm good at machinations.
Sorry to interrupt, but they're
Yes, ma'am.
saying they're not seeing the Facebook feed.
It should have been
Okay.
here live.
Who's up? Well, we had it pop up earlier. Okay, I hate hearing myself on because I have this awful Southern drawl that I don't like.
Is this, did they put you on delay because of what you say? Okay.
So
All right.
so that StreamYard can block me out. And your mic's working good too. So
All right. Good deal. So turn that down. Otherwise, it'll distract me. I hate listening to myself too. I sound like hell. So. All right. First of all, thank you for having me. I really appreciate it. I much prefer to do these live as opposed to do them online. I encourage you to ask questions as we move along. Sometimes I'm a bit of a gearhead, and I get in my own head, and I'm not paying attention to what you guys are after. This is going to be a killer because I like to walk around. One of the things that bothers people in my office is I'll sit there and we have a lot of glass, and I'll take questions on the phone, and I'm kind of pacing in my office, and it drives everybody nuts because they think something's wrong because I'm pacing. So anyway, I am a CPA by trade. I have an accounting practice as well. I am a principal in Mid-Atlantic, which is a self-directed company. We'll talk about that. I own real estate. I lend money. I own a liquor store, which is kind of fun, but that's on the Jersey Shore too, which is where I grew up. So I'm a little eclectic, and I'm a little bit all over the place. I do have good guests come with gifts. I have gifts. Please take these. There's some tax planning ideas in there. There's also some handouts which are on the slides, which we'll go over. And, so those are good primers for you as we move along. You can move to the next one there, since I know what I look like.
okay, we're gonna pass around.
Oh, okay, great.
We'll pass around
Okay.
sign sheet if you would.
Okay. So Mid-Atlantic is a self-directed retirement account company. We're referred to as a TPA, third-party administrator. We administer self-directed IRAs. We'll talk a little bit about that. Obviously going on. They could be Roth IRAs, traditional IRAs, solo 401ks, simple SEPs. There's a bevy of plans out there, which we can touch on a little bit. Account holders at Mid-Atlantic hold real estate, private placements, gold, silver, practically anything that you can think of, okay? Other than stocks and bonds. That is not our niche, although we do have clients that use their accounts to invest in stocks and bonds, sometimes when they have idle cash, but we're not a great venue for that. And I tell people that up front. So, probably about 65-70% of the holdings that clients have at Mid-Atlantic are in two main asset classes: real estate in some fashion, or they're lending. So you can, any of you guys ever use hard money? No, right? Okay. Not when you can help it anyway. Most hard money comes from self-directed retirement accounts. Even the hard money companies, basically where they're getting their funding is from self-directed accounts. So there you go. We can move on to the next one. This is my obligatory disclaimer and blah, blah, blah. What that basically means is that any information that you hear here is strictly for educational purposes. We do not, endorse any investments, promoters, all of those sorts of things. Anybody that I talk about up here and poke fun at is just my opinion. So take it what it's worth. You should always consult your own advisors on real estate, tax, and any other legal issues that you're after. We are not a fiduciary. That's okay. We're not a fiduciary as defined by IRS, DOL, any of the other alphabet soup in the government, state and local, blah, 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 blah. Okay. Tonight, my goal is to give you a general understanding of what self-direction is. Okay. Hopefully you'll gain some insight on how to use accounts, retirement accounts to fund your deals, to invest in real estate, grow your wealth essentially, and understand what that process is. Okay. Next. Okay. Just give you a brief history. Okay. IRAs started in about 1974. I was probably about 15 years old at the time. So they really haven't been around that long. Okay. Roths came into being. You can kind of roll through this. Oh, click, 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 click. There you go. Traditional Roth. Keep going. Qualified plans. Whoops. Go back one. This is going to be tough, isn't it? Okay. So traditional IRAs came about 1974, about 2000, right around 90, 85, 90. Roth IRAs came into being, and as usually happens, the way Roth came into existence is the IRS, or actually Congress, decided they needed a better way to grab money from people. So the contract was, you can put money in this account. You're not going to get a deduction for it, but the carrot was that the earnings are tax-free when you go pull it out at the end of the line. Okay, so the big difference between traditional and Roth is traditional, you get a deduction when you put the money in, but you pay tax on everything when it comes out. So the earnings, right, is tax deferred. Okay, Roth, you don't get a deduction when the money goes in, but when you pull it out, it comes back to you tax-free. And there's a couple of other interesting nuances between those, but that's the big difference. Qualified plans or company plans. So anybody have a 401k in here, involved in a 401k? Yep, that's a qualified plan, right? The difference between those plans is that, generally speaking, the rules with IRAs are universal. So whether you have an IRA with us, or Fidelity, or Vanguard, the contribution limits for 2022 are $6,000. And if you're in the over 50 club, which a couple of people here look like it, not you, but a couple of people, $7,000. Next year, or this year, 2023, there's a $500 push. So it's going to be 65 and 75. Okay. Those rules are universal. Okay. In qualified plans, 401k plans are what I would call company plans by companies. The rules are specific to that plan. Okay. So if you have a 401k with your employer and you have a 401k with your employer, the matching may be different. How you put money in may be different. What your investment options are different. And all that's dictated at the company level. Okay. So a lot of times we get a lot of questions about, I have a company plan, I have a retirement account at my company. Can I self-direct that? The short answer is no, because the company dictates what the investments are. Okay. All right. Let's move along. Maybe.
When you say the company dictates what the investments are, can the company state that it can be, their plan can be used as a self-directed?
They could. Okay. But so the question was, could a company say that the plan is self-directed? Okay. And they could do that, but you're never going to see that. All right. And the reason for that is that in your company's plan, whoever the owner of the company is, or the board of directors, or whoever the grand poobah at the company is, they're the trustee of the plan. So they have a fiduciary duty to make sure that the investments are prudent. Okay. So if your company allowed you to invest in an avocado farm, and you don't look like much of a farmer to me, okay, when that thing goes under, even though they said you could self-direct and you disclaimed everything and all of that, you can still sue the company because they didn't make a prudent investment. So you're never going to see self-direction in company plans unless it's only the owner. Okay. And we can talk about that. That's why in your 401k plan, generally, what do you have? You have a spectrum of like 5 or 10 mutual funds, and that's about it, right? What your boss is trying to do is to limit his liability for your investment options. And I mean, he's not being mean about it. That's just, that's just the way it is. Okay. So anybody in here have it? Yes, ma'am.
Will the TSP fall under the same type of custodial?
Right. So the question is a TSP a qualified plan? Yes. Whether the government or a governmental unit sponsors the plan or a private corporation, conceptually it's the same. Your TSP has certain rules, and that might be different from my company's 401k, for instance. Okay. So good question, though. So who in here has a self-directed retirement account besides me? Okay. All right. So we'll pick on you because you raised your hand, right? What's a self-directed IRA? What is a self-directed account? What do you think a self-directed account is?
You get to choose what assets you wish to invest in.
Yep. Okay. Anything else?
Yes.
There are certain limitations. Yep.
You can only invest like half of the amount, no more than the half of the amount.
Nope. No, I think what you're thinking about is a loan. So in 401k plans, a lot of plans have borrowing provisions for the participant, and generally you can only borrow up to half or $50,000 of the plan. That's a 401k plan. But I think what this gentleman said is essentially what you're looking at. Okay, so a self-directed account, a true self-direction, allows the beneficial owner, which is you, okay, to invest in specific assets at your direction. Okay, so the custodian allows a wide variety of investments. That's the first thing. Let's see what's next. Okay, as I just said, the beneficial owner, which is you, okay, fully directs the investment options, the management of those assets, and the vendors, if any, that are used to maintain those assets. Okay? So this is the above may be constrained by law or accounts of 5305. The 5305 is tax speak, okay, for the plan document. So when you open an IRA, any IRA, there's a document that talks about what the custodian does, what he has to do, or that entity has to do, what you have to do, and if there's a TPA or other people involved, what they have to do. That document is referred to as a 5305. Okay? Whenever you open an account anywhere, you should get that. Okay? All right. Any questions? Yes, sir.
Take funds from your self-directed IRA and disperse them to your LLC account without paying taxes? Can you invest in your own company, basically?
The question is, can you invest in your own company? We'll get to that. Okay. So, all right. So self-direction, very simply, allows you to invest in anything that you want so long as it's legal. Okay. And you're not using people that you're not allowed to use. And we'll talk about that. Okay. Next slide. Okay. All right. So let's talk about permissible investments. All right. IRS specifically says there are two things you cannot use a retirement account to invest in. Okay. One is collectibles and the other is life insurance. And I always add three other things to that list, and I'll tell you why. And if you shamelessly plug this, it's in here if you want it. Okay. So you pick this up, then this slide is in there. Okay. So collectibles, fine wines, works of art, rugs, anything that has that collectible nature to it. Okay, what I used to glibly say anything you see on Antiques Roadshow, but then they took that off the air, so I can't say that anymore. Okay, life insurance. Okay, some 401k plans will allow you to invest in life insurance, but this is for any plan. Okay, all right. The other three things I put up here on the list are not in the law. Okay, but they're not permissible for various reasons. Loans to the beneficial owner. So this gentleman was talking about borrowing, okay? You are a disqualified person, and I'll talk a little bit about that, what that means in a minute, okay? So if you borrow money from the IRA, the IRS or basically says you can't borrow, you just took a distribution, and it's taxable, okay? So no loans to the participant, okay, or the beneficial owner in IRAs. That's only in qualified plans, 401ks, okay? S corporation stock. Anybody in here have an S corporation? One. More of you guys need S corp. Two. More need S corps, okay? What's the criteria to be an S corporation for all you tax gearheads out there? Okay? There's two criteria to be an S corporation to qualify for sub S status. One is, okay, all of the owners must be individuals, okay? And the other is, although there has to be less than 125 shareholders. So the first one's pretty easy because they're statistically about 90% of the companies in the country have less than 125 shareholders. It's kind of interesting, right? Okay. The other, though, is that all the shareholders must be individuals. By definition, an IRA is a trust. So if an IRA invested in an S corporation, it would break the S election. So now the S corp would be taxed as a C corporation, and all the other shareholders would be very unhappy with you. So that's why I put that on the list. And the last is cannabis assets. And the challenge here is that, so think grow farms, dispensaries, and those sorts of things, okay? The challenge here is that although in virtually every state now, cannabis is in some, level of being legalized. So you go out to Colorado or California, it's basically fair game. Maryland, where I live, a lot of restrictions, okay? The challenge is cannabis is still not legal at the federal level, okay? So if you invest in a grow farm in Colorado and you live in Virginia and you take that money out of California and you bring it into Virginia, what are you doing? Right. Which is a very polite way of saying you're money laundering. Okay. So as soon as the feds catch up, then this will be okay. But the problem with this is not really it's not the IRS or the Department of Labor, who is the other entity that governs a lot of the rules with retirement plans. It's the banking rules, okay? So at this point, cannabis assets are still what we call administratively not feasible, okay? So those are the 5 things that you can't utilize a self-directed account or any retirement account for that matter to invest in, okay? So anything not on that list is fair game. Any questions on this? Nope. Okay. Excellent. Whoop. Go ahead. This is global. This is IRAs and qualified plans. So even if a qualified plan, so anybody in here have a solo 401k plan? Okay. So basically a solo 401k plan you can invest in real estate, lend money, basically do anything that you want to do in a self-directed IRA, okay? Except these things. Same rules, okay? All right, next slide. All right, another set of rules deals with who the account can transact business with. And there's a group of people and entities referred to as disqualified persons. And these are people that the account cannot transact business with. So transact business is buy, sell, lend, lease. You can just go through the list here. Exchange, lend, lease, provide goods, services, facilities, or provide a benefit, which means is a fancy way of saying guarantee. So if you have a loan, okay, the IRA cannot guarantee a loan or vice versa. And I'll tell you where this comes up a lot. How many people own their home? Right? Okay. What did you have to provide to the bank when you bought your house? Tax returns. They wanted to know everything you do, right? They ask you for a financial statement. They ask you how much money you got in the bank. Yep. Okay. And the other thing they have on there is, well, how much money do you have in your retirement account? Remember putting that on there? Okay. Way down deep in the guidelines, the underwriting guidelines of those loans, it says unless you are 59 and a half, which is the retirement age of retirement accounts, okay, the lender cannot consider retirement plan money for making you a loan. Okay? Because if they do, they blow up your IRA or your retirement plan, because in that case, the IRA or the retirement plan is giving you a benefit of its financial wherewithal. So anytime you're getting a benefit from the account, it's taxable to you. So the easy way to think about that is you take a distribution out, right? You got a benefit, you got the money, it's taxable. If you distributed an asset, you got a benefit, right? You got the asset, it's taxable. Okay? If it guarantees a loan for you, whatever it guarantees is taxable to you. Okay? So that's an instance where it works in reverse. Many of our account holders, and you know, well, there was another slide on this, although this is not a topic of discussion tonight, although we might delve into it a little bit. IRAs borrow money. Okay? If they do, it has to be non-recourse, meaning that you cannot guarantee the funds. Okay? But that's a topic for another day. Next slide. So disqualified people, 3 groups. Okay? And again, what the government does is it identifies the people and entities that the IRA or the retirement plan, I should say, cannot transact business with. So anybody that's not on this list is fair game. Okay? And if you're in a regulated business, a lot of this is going to look like self-dealing kind of rules. Okay? So the first one is family members. So if you sort of reach out in space and you put a dot out there, okay, and it's your account, that dot is you. If you draw a vertical line through that dot, anybody that's on that vertical line is disqualified. Ascendants, descendants, spouses. Okay. The second group of people are people that are on the account. So if your IRA is with us, which is where it should be, okay, all right, I cannot buy an asset from your account because I work for the account. Okay, I'm too close. Okay, and the third group, and in tax, there's always a fuzzy, right? The third group is certain other business relationships. So, and this is where a lot of the questions come up. So if the two of us are invested in an entity, and what's your name?
Brandon.
Brendan?
Brandon.
Brandon. He owns 8% and I own 6% of an entity. Okay? We are not disqualified with respect to each other. Okay? Because we don't, between the two of us, we don't have control. We're just merely investors in the same thing. Okay? But if he owns 40% and I own 30%, now we're going to be disqualified because between the two of us, we control the entity, right? We can make management decisions. We can tell it to sell assets. We effectively control it, okay? So we would be disqualified. So in that case, he wouldn't be able to lend money out of his account, for instance, okay? Now, quite frankly, you know, it's hard to ferret a lot of that stuff out, okay? So, yes, sir.
So does that mean if I'm in a joint venture with somebody to buy an asset, and I was going to put my part, my purchase of that asset through my 401k, I can't do that?
Nope, you can do that, okay? All right. So the nuance here, let's go to the next slide for a second. Okay, keep going. Oh, okay, so these are some examples, Okay, so we're talking about financial transactions between the account and the disqualified person. So for instance, my mother couldn't sell a property to my IRA. Okay, two reasons. First of all, she's disqualified. Second of all, she's dead. Okay. All right. It's been a long time. Don't worry. It's okay. Okay. All right. All right. My IRA can't buy a property owned by my father's LLC. Okay. All right. I couldn't rent it to my son, even at fair market value. All right. And this gets back to, this is sort of conceptually, this is the same thing as the guarantee that we were talking about earlier. What's the benefit? My son is basically gets the benefit of the property, right? Okay. You know, secondarily, if he had all his frat buddies over and they start punching holes in the wall, you know, what am I going to do? Yell at them, right? Okay. If you punched holes in my wall, what would I do? Wow. No, I'd sue you. Right? So I'm going to treat him differently, okay? All right. I couldn't, if my daughter's husband is a roofer, he's not going to be able to put a roof on the property. Okay? My IRA in that case is giving him a job, right? Okay? Secondarily, the other issue is really with all of these sorts of rules is how are you arriving at the value of whatever it is that's transacted here, okay? So, you know, take the example of the roofer. You know, in my area, I live up near DC. I can get a roofer, I can probably pay him an hourly wage anywhere between $15 and $40 an hour, okay, depending on whether he's union or pick him up on the corner somewhere, right? So the IRS doesn't really want to get into, you know, fair value and all those things. If you and I are dealing with each other, okay, we're going to arrive at a price that's beneficial to both of us. If I think it's too much, I'm going to ask him to do the job instead of you, right? If I'm lowballing you, you're going to do the same thing. Okay, so we're going to arrive at a mutual agreement. Okay, and that's, you know, if you think about a lot of these things in contract law, you know, virtually everything, you know, there's a construct where there's, you know, the parties are opposed to each other. You know, if we're talking about real estate, the seller is, you know, what's his motivation to sell? Wants to get paid, right? What's the buyer's motivation? Wants the property. You know, you're going to butt heads a little bit, but you're going to arrive at something that's agreeable to both of you, or find something else. Okay. And we talked about the guarantee. Okay, so the next slide is kind of a graphical depiction of this. One more click there, hopefully. Okay, and that's in this. That's in the handout, so you'll have that. Okay, so thinking about the first group here, family members. Who is not? We'll see who's paying attention. Who's not in this group? Siblings. That's right. Okay. So sibling rivalry is alive and well in the IRA world. Okay, so I could buy a piece of my IRA could buy a piece of property from my brother. Okay, interestingly enough. Now, keeping this as a backdrop, let's circle back to the question about using IRA money, investing in a joint venture. Okay. The nuance here is all of these transactions are buying or selling or transacting between the account and something else, right? In your example, you're buying something at the same time. So if I'm partnering, so if I put personal money into a venture and IRA money into a venture at the same time, is anybody getting a benefit of that?
The one that's loaning the money.
If it goes in at the same time, nobody's getting a benefit, right? because my IRA is not buying something from me. I'm not buying something from the IRA. We're just merely investing in the same thing at the same time. Okay, so that's the.
Loan money and then try to get money from an IRA later. Self-directed IRA. That's another.
I'm sorry, say that again. I didn't hear.
So let's say that I'm doing a project, run low money, and then want to dip into my self-directed IRA. No longer can I do it because it's not at the same time. When the,
Right,
when the
exactly.
venture
So,
first started this company.
so everybody hear what he said? So what he said is if he has a project going on, he's doing that personally, and he's running out of money, he's not going to be able to dip into his IRA or bring his IRA in to either lend money to the entity or partner, let's say, with the entity, okay? Because that would be prohibited, okay? All right?
Does it make it clearer if the entity is an LLC?
No.
Not necessarily.
No. Well, so there are a body of rules, okay, that basically I'll just refer to them as the indirect rules. If you could not do the transaction directly, okay, merely by putting entities or things in the way is not going to change the construct. If the essence of the transaction, exactly what this gentleman said, the IRS is going to look through all that and just say this is the transaction, and it's prohibited. Okay, and that happens in law a lot. Judges do that all the time. Okay, yes, sir.
So could you do a construct where I put the down payment is my personal money, loan is through the IRA, self-directed IRA, and it's got a timetable. So if I don't end up using all the money, I've still got some flexibility there.
No.
Yeah, I didn't think so. But I thought it was.
Here's very, very quickly. This is how I would do the deal. Okay, and this is just me, right? Okay, so let's say, and it's an all cash deal because it's after 6 o'clock and my accounting brain turns off, my math brain turns off. So let's say that I need to purchase price is $100,000. I need to probably put about another 50 in. So I'm all in at 150. I've got, I got $80,000 in my IRA, and I want to utilize all of it. Okay, so I'm thinking about the project. All in, I'm at 150. I'm going to give myself a little cushion, so I might put another, another 10 grand. All right, so I'm at 160. I form an entity. My IRA is going to be a the entity because that'll suck up the 80. Okay, I'll be the other 80. All right, so form an entity. IRA is going to put 80 in. I'm going to put 80 in. We're going to do it at the same time. That entity buys the property, 100 grand. Okay, I do the fix up, pay the plumber, roofer, this guy, that guy, the other guy. Spend the 150, probably a little more if it's me, because it never really comes in at where I think it's going to come in. Okay, when I sell it at 225, okay, I disperse the cash, 50% back to the IRA, 50% back to me. Okay, so very quickly, what I've done is when I form the entity, I think this is like, anybody ever read Stephen Covey? Okay. You go into something with the end in mind, right? This is the same thing. I need 100, got to the end, 150, bump it a little bit because I don't want to run out of money, right? Okay. Then work backwards, sort of algebraically. If I've got X in my IRA, total X divided by total gives me a percentage. Yes.
You can only do that through the entity though, right? So if you did 401k or IRA money with personal money without creating an entity, isn't that self-dealing?
No, I could do it without an entity. It's harder. Okay, and I'll talk to you. I'll tell you why. Okay, if I buy the entity, partially individually and part through my IRA, basically I've created a tenants in common, right? I've got an undivided interest and an undivided interest. Okay, in order to not violate those disqualified person rules, I've got to pay everything pro rata. Okay, so when the plumber bill comes in for $895, Half of that's got to come out of I got to stroke a check personally for half, and I got to stroke a check out of the IRA for half. And it just becomes unwieldy. So if I form an entity, I put the money in the entity and then do it out of the entity, just like just like we all do all the time. Okay. That makes it that just makes it easier administratively for you and for us. Yes.
I have a post 6 p.m. question.
Okay.
$100,000.
This might be a post 6 p.m. answer. Okay. All right. This could be a 2-drink answer. Okay.
Purchase property, you're 100.
Right.
You have is 50,000. You're all in for 150. You use a funds from a Roth IRA to do this, and then when you sell it, the gain is $50,000, and all that 50 goes back into the Roth. Is that also not taxed because the Roth is that ever taxed, that 50,000 gain? That's what I thought. So
No.
So one deal you can increase $50,000 and it's tax free because it's a Roth.
So the beauty of self-direction. Okay, I'm going to politely ignore probably the rest of my slides here. Okay, and this happens all the time. Yeah, that's all right. I know. Well, let's go see what the next one is. Otherwise, okay. We can run through this and then we can go through this. Okay, so
I don't know how many buttons are on here.
that's all right. Keep going. I'll tell you when to stop.
Right through. Next thing I know,
That's all right. All right. So let's just leave it here. Let's talk about advantages. First of all, the biggest advantage is control, right? You control the investments. Somebody else isn't telling you what to invest in or what you can invest in, what you can't invest in. All of that is up to you. You control the investments, the vendors, and your advisors. You always control your advisors, right? But the investments, usually somebody else controls. And many times it's the advisor, okay? If you're in a 401k plan, it's the employer. Vendors, all of us in here in real estate, we have our own, you have your team, let's call it, okay? When you buy property, you use your settlement company, right? Most of you probably use the same one time and time again, okay? Or you use ones that you like, let's put it that way. Inspectors, plumbers, tile guys, all of your vendors that you use to rehab property or handymen or all of that stuff, okay? In a self-directed account, as long as they are not your father, your mother, okay, disqualified, you can use your team, okay? Right? You get to leverage your knowledge, okay? For most accounts, if your account is at Fidelity or you're limiting yourself to stocks and bonds, how many of us are knowledgeable about the stock market? Are you really?
Enough to know what being and what not being.
Okay, so the market. Here's but okay. So that theoretic, okay, Donald Trump gets his information way before Jack Kiley does. Okay, all right, but very rarely are you going to beat the market. The market is the market, and it moves for God knows what reasons. Okay, and it's kind of like when you're in the ocean and it's coming. You got two options. You either dive under and get out of the way, or you get slaughtered. Okay, and it's kind of the same thing. And nobody really knows. Okay, I always have, in most of my presentations, I usually have somebody that works at a Fortune 500 company, and they say, well, I know what goes on at my company. Do you really?
That's what they said in Enron.
That's right. Only one guy knew what was going on at Enron. Okay. But but really, what do you really know about what goes on? Okay. Now, I'm not saying that you shouldn't have money in the market. Okay. I have money in the market. Okay. You want to diversify. Okay. But if you invest in things that you know about, two things happen. First of all, generally, you're going to get a better return on investment. Okay. And second of all, you're going to watch it better. You're going to mind what's in there. Again, I have an accounting practice, and during tax season is the one point where I see virtually all my clients, or I talk to all my tax clients. And I would bet about 3/4 of them look at their retirement plan, their portfolio that they get from the brokerage firm, like once, maybe twice a year at most. Okay. For those of you who have, for instance, rental property, or you do rehabbing, whatever you do in real estate, if it's your passion, how often do you look at that property? Okay. All the time, right? Okay. Because you understand it. Okay. You can invest in a micro level. And by that, what I mean is you can invest exactly where you want to. I have a client in Alexandria, Virginia. She invests only on one street. Why the hell do you do that? Her answer is because I like to look across my yard and see the properties that I own on the other side. All right. That's her deal. Nothing wrong with that. Nothing wrong with that. Okay. But it's an example of you can invest in exactly where you want to. Okay.
Jack, I have a question.
You bet.
I am not clear at this point, so maybe you can clarify for me. I was always told that with a self-directed IRA, you could not invest in your own deal. And it sounds like from some scenarios you've been mentioning that there's some circumstance where you can.
Well, I would argue, first of all, every deal is your own deal. Okay. When you find it and you invest in it, that's your deal. Okay. When you're talking about partnering money together, okay, again, those disqualified person rules are transactions between parties. So that's an exchange of money, assets, value between parties. Okay. But when you invest side by side, nobody is buying anything from the other person. Okay. You're putting money in play at the same time. Okay. So it's a subtle nuance, but it happens all the time. And I'll give you an example where this happens in private equity. Has anybody ever invested in a I call it a syndicated deal, where you've got a Reg D deal where you've got you got to be an accredited investor and all these sorts of things. Okay. Usually there's a threshold with those things, $50,000, $25,000, $50,000, $100,000, whatever it is. Those guys will allow you to put IRA money beside personal money to get to the $100,000. Okay. Conceptually, that's the same thing,
Well,
right?
Let's take a scenario. I've got a self-directed IRA.
Mm-hmm.
I buy houses, fix them up, have residents go in and receive cash flow. Benny does the same thing.
Mm-hmm.
My understanding is I could take my self-directed IRA and invest in Benny's deals,
Mm-hmm.
but I couldn't use the money in my own deals to buy properties.
Give me-
buy or sell your own house. You have to buy a house from somebody and then sell it to somebody else with your IRA in the middle. I think what you're mixing up is.
Go ahead.
I don't know
Fire
how you
away.
feel, but
No.
because I'm hearing you. If I've got a house already, I can't sell it to my IRA.
Okay.
I cannot buy a house from my IRA. That's self-dealing right there. But I can buy a house from Janie
True.
and then sell it to Thomas. Buy a house from Janie, fix it up, sell it to Thomas.
Put the rehab part in there.
I buy a house from Janie, I rehab it, I sell it to Thomas, or I rent it to Thomas.
Well, let's say I'm gonna keep it.
Then I rent it to Thomas. I can't rent it to my son.
Of course.
I can't rent it to my mother. I can rent it to my brother. I can rent it to my sister.
But
you
it was
can-
Is that correct?
But you can still own.
You're
the
hired.
property. You can still own the property,
And-
correct?
Yeah,
Your
he's,
IRA owns the property.
hold on,
You know, that property, I purchase and rehab.
Correct.
out of the IRA,
As long as you don't
out of
buy
the
it
IRA.
from the IRA or sell it to your IRA.
Or anybody that's disqualified cannot do the rehab, you couldn't have bought the property from them and you can't sell it to them, okay?
So
Yes.
anything on the MLS you find or wherever you find your properties, your IRA your self-directed IRA can purchase those and rehab.
Can't
Yep.
buy it from your mother though.
Right.
Or anybody in that.
Good.
The point I was gonna make, so you buy a house, you're gonna rehab it, you purchase the house, that's a chunk of money. You do the rehab, that's a chunk of money. Every dime you do, whether it's the purchase or the rehab, has to come out of the IRA. You can't mix private money for the rehab and IRA money for the purchase.
Right.
That's where a lot of people were like, oh, I got
Right.
enough to buy it, but I don't have enough to rehab it.
But you can use IRA money and get a loan if you can't. If the project is 200,000 and you only have 100,000, you can use a combination of a loan and your IRA.
I'll give you a quick example of that. Yes. Yes, ma'am.
Also, another situation, right, you can't live in it. So like, if you're doing a deal where you're never gonna live in it, that's fine. But like, my dad can't invest in a property that I'm buying to fix up, but then I'm also gonna live in it while I'm.
Right. And that gets back, if you think about those disqualified persons and that transact business, that's use. That's a use. Okay? Yep.
What is the youngest age you can invest into IRA?
So the question was, what's the youngest age to invest or to open an IRA? Okay? As long as you have earned income, okay, that's the driver for making a contribution to an IRA. So I have clients who are actually in the real estate business, and you ever see these? Make sure there isn't anybody in here. Okay. You ever see these flyers? The real estate people will put out there, and they'll have like a little baby in the picture, right? A Gerber baby, like in the advertising or the photograph. I would bet that that's the real estate person's baby, and they're paying the kid to be in the picture. And what they're doing is they're paying him, I don't know, $5,000-$6,000, and that money is just going into the retirement account.
Put your children to work.
It's a great thing. Kids should always work. Yes, sir.
When you say can't, can you describe the penalty? Are you talking about like a tax penalty or is this actual laws you're breaking?
All right. So what happens? No, nobody has ever gone to jail. Okay. But it'll cost you. So if you enter into a prohibited transaction, and that's what it's called, two things happen. First of all, the account is immediately distributable at the point that disqualification occurred. So the challenge here a lot of times is that, you find out 2 years later, or the IRS more correctly finds out 2 years later that there was an issue. Okay. So that penalty is retroactive to the year in which the prohibited transaction occurred. All right. Secondarily, it's distributed, so you pay tax on it, and the penalty is 50% of the tax. Okay. So let's just say, back of the napkin, that it was $100,000. Okay. $100,000 immediately taxable is probably going to cost you about $30,000. Okay. That's a $15,000 penalty. Okay. By the way, you look suspiciously under 59.5, so there's a 10% penalty for an early withdrawal. So that's 10, 35, and 15. Are we at 60? Is that right? Oh, my accounting brain didn't turn off yet. Okay. So 60,000. We haven't gotten to the state because Virginia's going to get its pound of flesh from you. And you're going to have to go back and amend the return for that year. And you're probably going to have to amend every successive return, because if it was a property, that house is now owned by you personally, not in the IRA, which impacts your return last year and this year. Okay, so it's complicated. Okay, and the reality is too, one of your takeaways from this should be, if you use a little bit of forethought, you can usually do what you want to do. You just need structure, and you need to think about it first, rather than get 3/4 of the way down the pike and say, hey, I need to do this. So if you're a back of the napkin, art of the deal kind of guy, okay, you're going to struggle with this a little bit. If you're meticulous, if you like order, you have a military background, an accounting background, a healthy appreciation for rules, you'll be okay. Okay? All right. So, do you have a question? I'm sorry.
Yeah, you asked the question about the penalty. So I guess if you were not doing an allowed transaction, is there like a statute of limitations on how far back they can look at your investment? I'm just curious. Like, would it be, I guess, uncovered?
Okay.
Well, if it's an
Well,
open-
this is all. So in tax, what happens is there's a statute of limitations, which is 3 years from the date of filing. So if you file your individual income tax return today, okay, for 2022, so we're in 23, 4, 5, 6. So in what is it? January 12th, 2026, that return is out of statute. The challenge with IRAs is, when does an IRA file a tax return? Never. Okay. So the statute of limitations never runs because there's nothing that's been filed. Okay. So usually the next question is, how the heck could they ever figure this out?
You do file something, that was it 550 EC or something?
Okay. If you have a solo 401k and your assets are over 250, you file a 5500 EZ, which is just an informational return. Okay. So you might have, yeah, there is same statute. Okay. So you might have an out, okay, with the plan, although I don't think it's going to save you. Okay. But in IRA world, generally there's nothing that's filed. Okay. Or, IRAs do file returns and things, and this is sort of the 5500 issue. Okay. But it's not specific to the assets or to the activity in the plan, which is where IRS or Department of Labor would probably prevail. Okay. So the next question is usually, how the heck are they going to figure this out? Okay. Generally, they don't. Okay. Usually what happens is somebody else figures it out. Okay. So I'll pick on you. Okay. So if you do a deal, okay, you use self-directed money and you're rehabbing a property and that deal goes south. Okay. And this gentleman who's laughing over here lent you money. Okay. So now he's really pissed off. Okay. Because he's not going to get paid back. Okay. So what's he going to do? Because he's like a dog with a bone, man. Okay. All right. So what he's going to do, he's going to turn your life upside down, because what he wants to do is he wants to break that IRA to make it a personal asset and then be able to come after you personally for whatever it is that you owe. Okay. So a lot of times it's not the government that starts this ball rolling. It's somebody else. Okay. So be nice to everybody is the key. All right. So anyway, let's roll through the rest of these because you're running out of time.
Well, I do, but I also have somebody.
Has a question?
Online that has a question. So, can an individual wholesale under their self-directed IRA? And if so, what source do the marketing funds come from?
Okay.
In order to do that?
All right. So any wholesalers in here? Okay, right. You guys got a problem, okay, in the self-directed world, okay? Because when you wholesale a deal, okay, what are you doing? Miss Wholesaler, what are you doing?
Selling a contract.
All right. What's the contract say? You take control of the contract. So you have paid something for the contract, right? You're allowed to say yes. Somebody or the IRA, somebody. I mean, because well, unless you and forget IRAs for a second, okay? Unless you have an obligation where you've paid for it, you have nothing.
Right.
Okay. All right. So you've paid something. The presumption is now you own the contract. And the presumption in the contract is that you can perform on the contract.
Right.
So if push comes to shove, you got to buy the property.
Absolutely.
Okay. In the IRA, this is usually, and you hear all the gurus do this, and this really, they're not very happy with me a lot of times. You'll hear, you can go and open an IRA for $1,000, $5,000, and you can wholesale to your heart's content. You cannot do that. Okay? If the IRA buys a contract to purchase a property for $100,000 and it only has $1,000, how on God's green earth are you going to fulfill that contract? Is the IRA going to fulfill that contract? It can't. And there isn't and usually what somebody will say is, well, I can go borrow the money. There is not. I want anybody who is going to lend me $99,000, non-recourse, by the way, to buy a property, to raise their hand. Okay? You are never going to be able to get a loan. Okay? So the only way wholesaling really works in a retirement account is if the retirement account has enough money to perform on the contract. Okay? The other gate that you sort of run through is wholesaling at its essence is what? This is going to get a little wonky.
Trading.
It's trading, but it's a service, right? You're providing a service. Who's providing the service? The individual, right? In this case, you are, okay? So that's a business, okay? All right. So in the IRA, which doesn't have, money, usually an IRA, a retirement plan buys things and stuff, right? Buys assets, hard assets, buys stocks, bonds, real estate, lends money. Those are all assets. And it gets paid. It gets a return on that investment. This is a service. Okay. There's an argument that that's not permissible in the IRA. Okay. Now you could, I'll sort of use another example here. So somebody might say, well, if I manage my properties, I'm providing a service. Okay. Well, first of all, you're managing the assets in the portfolio. That's different from selling a contract. Okay. So you might still have an issue there. But if you take a contract, if you're wholesaling, and in the IRA you've got $100,000 and you buy the contract for $1,000, you might, I think you got probably a 75% chance of prevailing on that. Okay. But my message is that you've got to have enough money in the IRA to actually perform on the contract. Okay. So that whole construct of open an IRA for $5,000 and wholesale to your heart's content is probably not going to work. Okay. Now, in the times that I have wholesaled in my IRA, what's a way that you could do this and make this a bonus? How could I make this bulletproof? Okay.
Separate entity.
Well, actually, no, I'm going to rephrase this. So if I'm, a lot of times the other thing that comes up is rehabbing is a business also, right? So what's the difference between rehabbing and wholesaling? Right, you own the property. Okay, so although you're managing, a project, okay, and getting a property to sale, okay, that's different than wholesaling. Okay, so again, the message is you got to have enough money in the account to do that, and I don't know that I would just do that in my account, because that looks more like a business than an investment proposition. Yes, sir.
So then can the IRA do a double close, buy it and sell it the next day and make the profit that way?
Well, you could, but a lot, in order to get the asset, the challenge is on the buy. In short, you could. Okay. These days there are not, at least where I am. Okay. There's not a lot of, in fact, I have not seen a simultaneous sale in several years, quite frankly. They usually are going to want a couple of days between. Okay. And I think, that changed a couple of years ago. Have you done that? No.
I do that.
Do you still?
First transaction has to be fully funded for the second one.
Right. Right. So it has to be, so you got to have all the money is the point. Right. Right.
People lend for.
They're not doing the double closes where you're not
Right.
fully funding it. and
Right.
then-
You're not doing a pass-through double.
Right. Exactly. That's the term I was looking for. Right.
that-
Yeah. And that kind of, quite frankly, that kind of looks like a wholesale anyway, All right. So anyway, go ahead.
Question on the contract. If you have a contract to purchase a property that does not obligate you to close because there is some element of contingency in there, but you sell that contract, you're wholesaling, and you actually do have an asset, and the asset is the contract itself. Correct.
But you got to have enough, in order to acquire the contract to begin with, you've got to have the money to do that. So
Consideration for a contract.
well,
requires
but for instance,
dollar.
right. But for instance, what happens though, if you're looking to buy a contract from me, okay, for instance,
Right.
I'm going to look at you and make sure that you have enough money to do the deal, because the whole reason I'm selling the contract to you is because I don't want the property anymore, right? So I've got to be happy with you, and ultimately your presumption under law is that you have the wherewithal to close on that contract, because technically, and this is really what's been posited with the IRAs. Okay, if you enter into a contract, if anybody enters into a contract under false pretenses, what is that? Fraud. Okay, so an IRA, if it's only got $1,000 and it gets a property worth, pick a number, somewhere north of $2,000, okay, under contract, what is that? Fraud. Okay, and that's the challenge that you run into, and you're gonna, there's a lot of people that'll give you a lot of different opinions, but that's, I think that's the biggest issue. Okay, last question, we're gonna move on.
As a seller, let's say I have a property that I'm looking to sell, have an IRA that you're looking to purchase. How would a seller identify that buyer is purchasing within an IRA?
Because the contract for sale is going to be in the name of the IRA. So if I'm looking to purchase something in my IRA, it's going to read Mid-Atlantic IRA FBO, which stands for the benefit of Jack Kiley, IRA, Roth IRA, whatever kind of account it is. Okay. And then if you're unfamiliar with it, what you're going to do is you're going to look at that contract and you're going to say, Jack, what the hell is this? Okay. And then I explain it to you. But right, and basically what will happen is, it's treated as a trust. Okay. So let's move on. A couple of disadvantages are sometimes it's too flexible. So people get there's almost too many options. Okay, so it's sort of like analysis paralysis kind of thing. And then your custodian is not going to give you any advice. Okay, you've got to look to your advisors, tax advisors, real estate advisors, legal, blah, 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 blah.
So is that they do not or cannot by law?
Well, if they give you advice, they are no longer a custodian, they are now a fiduciary. Okay? So if you think about your stock trading guys, your financial planner, he gives you advice, okay? He has a fiduciary duty to give you good advice based on a bunch of criteria, okay? People ask me all the time, because they know I'm a CPA and all those things. I say, they say, is this a good deal? Okay? And my answer is, quite frankly, I don't know if it's a good deal for you or not, because the only thing I know about you is how much money you have in your account. Some of you I know a little better than that, but I don't know what other things you're invested in. I don't know your aversion to risk. I am really not in a good position to make that kind of assessment. Okay? I don't know what your level of expertise is in the asset that you're looking to purchase. Okay, so the custodian is not in a good position anyway. Okay, but you're not going to get advice.
When you say will not or cannot provide advice, can you help structure the deal to make sure that we're staying within the left and right limits?
Yeah. So
I've got a $400,000 deal. I've got 65,000 in my IRA. How do I make that work?
Yeah. So if and people ask me all the time, look, I want to use these funds and those funds. How do I do that and stay in compliance? That's a different question than is this piece of real estate a good deal? Okay. Or, I'm combining this money and that money. Is this smart? I don't know you. I don't know if it's smart or not. Okay?
Is it illegal? Is that a fair question?
That's a different question.
Okay.
That's a different question.
Okay.
Okay. I answer that question all day long.
All right.
Okay. Yeah, but you get the nuance, right? Okay. Good. All right. Next. All right. So how can self-directed accounts help you? And really, this is through the prism of growing your wealth. All right. So first of all, again, you get to leverage your knowledge. You invest in things that you know about more intimately than maybe other things. So you can be very specific. You invest in the kinds of property that you like. And everybody sort of in real estate, just like everything else, I would expect most of you have a niche. It might be townhomes, it might be single family, it might be 3-2s, it might be, whatever it is. Okay. You can invest in that same kind of property in the account, in the IRA. Okay. Use any structure to hold the property with the exception of S corporation. And quite frankly, from a tax standpoint, holding real estate in a corporation or an S corporation is not good anyway, but that's a different discussion. So you can use any structure. You can use debt. We talked about that. Strategy. If any of you have attended seminars on how to buy or how to do this or how to do that, follow this guru, that guru, you can put all those plans into action. Okay. With the exception of wholesaling. Okay. All right. Use your team. We talked about that. Okay. And you invest specifically where you want. Those are all very powerful ways for you to grow your wealth. And the reality is, statistically, what is your biggest asset? Your home, right? Personal residence. What's your second biggest asset? For most people, it's their retirement accounts. Okay? So that is where the bulk of your funds are. And if you can take that and invest it in the manner in which you want, in the things that you want, in the things that you do all the time, you are more likely to get a better return. Make sense? Good. Next slide. Okay, so let's talk about the process real fast. First thing is you got to open an account. Nothing happens till you open an account. Okay? If we're talking about property, when you make your offer, you want to make it in the name of the IRA. Okay? So many times people will offer personally and then they will want to assign it to their IRA. You can't do that. That's exactly right. Because if you assign something to me, although I'm a really nice guy, you want something for it, right?
Right.
All right. You wouldn't want anything from me, would you? You're a liar. Of course you would. Okay. All right. So if I assign something from myself to my IRA, there's a presumption of an exchange of value. Okay. That's prohibited. So if you do the contract in your own name, you're going to have to go back and rewrite it, get it rewritten. Okay. Because you don't want to assign it. Now, usually what happens is somebody will say to me, well, I have an LLC and I assign things from my personal name to my LLC all the time. Why is that permissible? Somebody said over here, it's the same person, right? You're just assigning something from you to you, okay? But the IRA is a separate entity from you entirely. So you got to think of your IRA as being like Fred Smith, okay? It's a third party, okay? So that's why, for instance, if I assign something from Jack Kiley to an LLC that I control, it's not, there's not an exchange of money. I can do that all day long, okay? Because I'm just assigning it to myself, okay? Can't do that in the IRA world. What I suggest to a lot of people, or to everybody, is to basically, when you make your offer, make it in the name of the IRA and or you, okay? Give yourself flexibility, okay? That does two things. First of all, in the haggling back and forth, in the Monty Python, you got to haggle. A lot of you guys look too young for that. Anyway, that haggle can be done. You can do all that. You don't need to run to the IRA for signatures and dotting of I's and crossing of T's. So you're allowed to do that, okay? Once you get a ratified contract, you're going to send that, at least with us. We want to know when you're starting the deal. Okay, a lot of other custodians don't want to see any paperwork until you have it all together. We want to know at the beginning. We're going to contact the settlement company, and we're going to wave our hand and say, this is an IRA. They're going to need some things from us. We need some things from them. And the other thing we're going to tell them, which is not such an issue anymore, is I'm not going to settlement. So you got to treat me like an out-of-town buyer, right? So you can't put the paperwork together at 10 o'clock in the morning for a 2 o'clock closing. Got to give us time, all right? The other thing that helps with is scheduling, quite frankly. And as questions come up and you have things that come up, I mean, real estate's a complicated transaction, okay? As all those moving parts come together, sometimes there's questions and whatnot, and we can help you address them, okay? So that's why we want to know at the beginning of the deal. We'll get you to sign something called a bi-direction letter, which is just a fancy name for a form that we have that says, basically it's your declaration that says, I want to buy 125 South Market or whatever, okay? So ratified contract, bi-direction, we move towards settlement. They jump through whatever hoops are going there. Okay. At some point there, we get a good set of documents. You're going to read and approve them. Okay. Because we want to make sure it's exactly the deal that you think it is. How many times have you gotten your settlement paperwork and you look at it and you go, no. There's something wrong here. Okay. We want to make sure everybody's on the same page. So you approve it, everything looks good, we fund settlement, okay? Once settlement occurs, title will pass to your IRA. So the title on the property is going to read Mid-Atlantic IRA, FBO, your name, comma, IRA, Roth IRA, whatever kind of account it is. And what that tells anybody who cares to look is that you don't own the property, and we don't own the property. The retirement plan owns the property, okay? And if you want to be somewhat anonymous about the deal, which really doesn't work very well these days anymore, you might say FBO account number 12345, comma, IRA, okay? So We don't get a lot of that anymore, but some people want to do that. They don't want their names on it. Okay. So again, title passes. Any contracts need to be in the name of the IRA. So rental agreements, maintenance contracts, insurance, okay, all those things are in the name of the IRA. Okay. All income attendant to the asset or the property comes back in the IRA. So if it's rent or what have you, think of it like a dividend on a stock, right? What happens when Google pays a dividend to your IRA? It goes back into your account. Tenant pays rent on a property owned by your IRA, it comes back in the account. Okay. Any expenses attendant to that property must be paid out of the IRA. Okay. So many people use a property manager. Okay. If you use a property manager, property management agreement is between the IRA and the property manager. Of course, you're going to negotiate and all those things. But basically what happens there, property manager collects the rents, pays out the menial expenses, and then remits whatever the the residual of that is back to your account. Okay. Pretty simple transaction. A lot of times when somebody is for the first time, so that's the process of purchasing a piece of real estate. A lot of times when somebody is opening an account, there's two things that are happening at the same time. There's this, right? But there's also transferring money from old IRA to new IRA. So in the account opening paperwork, there's an application and there's a transfer form. If money is moving from an IRA to IRA, it's a transfer. It's referred to as a transfer, and you need to use the paperwork of the successor custodian. So if you're moving money to us from an existing IRA, you use our transfer form. All that comes back to us. We send that. We have to countersign it and send it to Fidelity or Vanguard or wherever your funds are, and they will act on your instructions. If you're moving money from a 401k or a qualified plan, a TSP, or those sorts of things, you have to start with the administrator of that plan, because every plan has its own rules and regulations and paperwork and things that it's got to satisfy. So you complete that paperwork, and then they will issue the money to your IRA. Now, two things there. First of all, you want to make sure that you are not taking a distribution from the plan. If you are completing the paperwork and it looks like a distribution, excuse me, there is a required 20% withholding. Okay. Once that money leaves them, you're going to have to wait until you file your tax return to get it back. So if you are transferring, or you rolling over is the term, $100,000, and you told them it was a distribution, you're only going to get a check for 80. Okay. So you're going to have to replace the other 20 out of personal funds or pay tax on it. Okay. So you want to be sure that you're completing a rollover. The second thing that happens, even though you sell them and that'll be an option to wire the money, they never do that. They always send a check, and they're going to send it to you payable to the IRA. And I don't know why they do that, but they just plans do that. Okay. Don't panic. You just get the check. You just send it to your account, and that's fine. Okay. It just cannot be written to you personally. Okay. All right. So usually what's happening is that transfer process is going on the same time that you're moving the asset, trying to acquire the asset. And if things, move symbiotically, then it all happens pretty close to the same time. Okay. And that is the process. And I think that's pretty much. Okay. So again, takeaways: you're in absolute control of the account. You can diversify the account out of stocks and bonds, leverage your expertise. Okay. And that's it. I thank you for your time and your participation. There'll be a test next week. Okay.